Now to the latest on the BP oil spill. Attorney General Eric Holder has opened a criminal and civil investigation into the disaster. He says the government will closely examine the actions of those involved in the spill for any possible illegal behavior. The U.S. Coast Guard seized a section of pipe from the leaking well as part of the investigation. The National Incident Commander, Thad Allen, says that the first relief well aimed at plugging the leak is 7 to 8 days ahead of schedule. Some good news there. But Allen says that the well still probably won't be sealed until mid-August. So until that time, oil continues to spew out of the ground in the Gulf, and the economic implications of the BP oil spill are far-reaching. But even though the well is still spewing, PIMCO says that when it comes to bonds in the energy space, there are some attractive ones there. Mark Kiesel is PIMCO's global head of corporate bond portfolio management. He joins me now live this morning from Newport Beach, California. So it sounds like, Mark, you're saying that the concern is overdone here, and you've made an interesting argument framing things in sort of a Houston versus Washington reason for how the market's pricing things right now. Can you explain that?
Yeah, well, I think both the bond and the stock markets are pricing in three risks. One risk is, can the relief well be successful, and can they kill the well? The second risk is the unknown, which is really the legal liabilities. And the third is really more the commodity price risk. The stocks and the bonds of these companies, however, are pricing in my opinion, those risks. And you're now seeing corporate bonds in these companies trade at basically single B, a junk high yield spread or yield, and these companies are still investment grade and have significant financial flexibility. So basically, I think the market is pricing in a pretty bad scenario, and there are some good opportunities.
Well, I mean, devil's advocate here, say it's hard to not go to the worst case when every time you hear the latest update on how much oil is coming out of the ground, it's up by multiples. You know, now we're talking about worst case 100,000 barrels of oil coming out versus the original 5,000 that was reported. The credit rating agencies are also out there saying we're watching this very closely and we're concerned. Are people being overly aggressive? Are the ratings agencies being overly aggressive?
Well, I think it's prudent to be cautious because there are a lot of uncertainties. What I think is important here is that these companies are real companies with strong balance sheets and good financial flexibility and assets. These companies can raise cash in the secondary market through new debt issuance. They can cut capital spending. They can cut dividends. They can monetize their asset bases. These companies are sitting on proven and unproven reserves. In some cases, the proven reserves cover debt, plus even worst case liability assumptions 2-3 times. The market's not giving these companies any credit for unproven reserves. And so if they are successful in killing this well, there will likely be a lot of upside.
So are you saying bottom line is bankruptcy for BP shouldn't even be talked about? It's off the table?
Well, certain constituents would want to talk about it, mainly those that would benefit from it. Bankruptcy doesn't make sense for these companies. These companies operate all over the world, have contracts with governments and other businesses. It is critical to their going concern to remain investment grade rated and to remain a viable business. And bankruptcy does not solve that.
All right. It's an interesting piece, Mark. Thank you for coming on today and sharing your perspective.